Good morning, ladies and gentlemen. It was this morning when I was reading the case, it was all about the wall and the glass wall, the dividers. I could only think of this office in downtown Montreal where the place is very limited and they have the divider and it's all the glass wall. So it's a very smart idea to do all these things, to use very limited place in an efficient way where we can share the offices. So who's doing all these smart ideas? The Moderico Inc. is one of it. So we, Synergy Accounting Solution team, welcome you all to give your valuable time to attend this presentation. The outline for our today's presentation will follow. I will be doing a brief introduction of the company and we will continue with the ratio analysis and the SWOT analysis, which will let us to identify the problem statement and the objective statement of the company, and we will finally recommend some recommendation for the company to achieve their objective and conclude with a brief conclusion of the company and the presentation. So Moderico Inc. is a Canadian family-owned company. It is headquartered in Boucherville, Quebec. It was founded in 1984. The business model they have is a B2B. Basically, they design, they manufacture, and they distribute. And what they are specialized in is in the mobile walls, movable glass walls, and the dividers. Who they are serving is more the commercial, industrial, and residential uses. And their presence is very international since they are in more than 30 countries around the world.
So now we'll be talking about the ratio analysis. We have to take in consideration that we only analyze the company horizontally based on the previous year because we didn't have any other source of information such as the market industry. And first of all, as we look at profitability measures how profitable is the company, how much profit is the company generating. And first of all, we start off with the gross profit margin. From 2015 to 2016, it has increased because from 25.98% to 26.33%. This is because their sale has increased. And now, when you go down to the operating profit margin, when you remove the expenses, from 2015 to 2016, it went from 18.87% to 17.24%. This is because they had invested in advertisement and promotion, and also research and development in order to have a better sale than the previous year. Next is the profit margin. From 2015 to 2016, it went from 7.12% to 6.78%. This decrease is due to because in 2015 they haven't paid taxes, and in 2016 they paid the taxes. That's why there's a decrease. And as well, and 6.78%, it means that sorry. It means 6.78%. It means total assets. Okay, next one. I'm sorry. Return on total assets from 2015 to 2016, it went from 10.66% to 12%. This is due to the sale has increased from the previous year. And then after the return on total equity, 2015 to 2016, you see there's like has been a decrease. This is because they have invested in research and development, and also they have invested in the capital investment. They have increased their capital investment. And we use the stoplight sign in order to allocate where they're in danger. If you see green, that means they're doing good. If you see yellow, that means they should pay attention to it. And if you see red, they should take immediate action for it. So sale has increased from the previous year. That's green, it's good. And increase in discretionary expense due to advertisement and promotion and R&D. And they should pay attention to that because it's pretty high. Okay.
Further, we're going to look at the activity ratios, and here
we see that inventory turnover has improved between 2015 and 2016, which is because of the increase in sales, and also they increased the number of inventory, the amount of inventory that they were holding or they were producing. Similarly, the inventory holding period sees a decrease between 2 years. It has reduced by 7 days, which is mainly because they are selling fast enough, so they're not holding a lot of inventory. This will help them decreasing their operating cost. So it's a good sign. You can also see we have given it the green signal. And then we're going to come to receivable turnover. Again, as my colleague mentioned, we don't have an industry average to compare to, but looking at these 2 years, they definitely have improved between both years. So you can see in 2016, they received their accounts receivable at the 78th day. Probably they gave incentives to their customers, which are distributors and retailers. They might have offered them net 10 or net 20 or those kind of promotions, so they could receive that money fast enough. Further, we're going to look at capital asset turnover and total asset turnover. It has also seen an increase in those numbers, which is again because of increased sales, and it has also improved leasehold improvements. They have invested in rental improvements, and they have invested a lot in research and development, which they were not investing in the previous years.
So now we're going to talk about the liquidity ratio. The liquidity ratio measures how liquid is the company in order to meet its financial obligations. So first of all, we start off with the current ratio. From 2015 to 2016, as you can see, it has improved from 2.05 times to 3.19 times. And this explains that for every dollar of debt they have $3.19 to cover those debts. And the increase is because they had increase in their cash flow, they had increased their inventory, and also their receivables. And next, we take a look at the quick ratio. The quick ratio evaluates the current assets without the inventory. From 2015 to 2016, it went from 1.39 times to 2.02 times. This is good. So this explains that for every dollar of total debt, they have 2.02 times if short-term obligation, like immediate short-term obligation, they have $2.02 to pay to cover that. So under working capital is the current assets less the current liabilities. And as you can see, they have a lot of working capital. They have increased their working capital. This shows that they have increased their receivables and their cash inflows. And to conclude is, basically we allocated green because they have increase in cash, inventory, and accounts receivable, which leads to high liquidity. And their cash inflow and decrease in liabilities has improved their working capital in order to invest for them in their operating activities.
Now we come to leverage. Between 2 years, there is a decrease in debt ratio. However, again, the same reason we can't compare it to the industry. We don't know if it's a bad thing or good. I mean, just looking at the numbers, it's quite high. And there is a decrease between 2 years both. Well, in all of them is due to because they paid most of their long-term and short-term liabilities on time. So that's why you can see that there is a decrease in debt ratio, debt to equity, and long-term debt to equity ratios.
So for the strengths, we already saw from our analysis that the company is very highly profitable, and this is all because their sales increased, so as their cost of goods sold also increased, but it still led them to have a gross profit margin quite high compared to their last years. And The another strength that the company has, they are very efficient at operations management, because it was set in the case that before they really had issues with the process time and the production was really not fast. The employees were overloaded with the production. So what they did was they efficient and they strengthened that part to have effective and efficient operations management. And reconstructing operations activity is all about, because the company was facing a lot of problem with their operation, which included their marketing, their R&D, marketing and research, and their operation itself. So they looked at all those issues and they reconstructed, which was all to increase the sales, and which they strengthened it on it. And the other strength that they have is the MBO, which is objective by management, management by objective story, which they actually involve their employees to be part of the operations and the decision-making process, so they can create their own objective, and by end of the day they can reach those objectives, so which will help also the company to increase their sale, which they did it. And they also have a diversified product range, which I already said in my introduction, that they have like the movable glasses, the dividers, and also the product range is very wide and it's diversified. And they also have the customized product, because they also have the competitors, but the competitors are not doing the same thing as this company is doing. What they are doing is they customize their product based on the customer needs, to satisfy their customer, because that's the main point also in the business, to increase the sales when the customer is satisfied and the sales goes up. And the international presence is also another strength for the company, since it's exporting into more than 30 countries around the world. For the weaknesses, we couldn't find any weaknesses for the company, because the company had issues, but they tackled them. It was more about because employees have problem with the human resources, the operation, but they all tackled it, so it was all fixed. So what we have for the weaknesses, the company still have a high debt, which is 59% almost in 2016, so that's quite high. But again, we didn't have the market industry average to compare with it. It was the horizontal analysis that we did. And the high discretionary expenses is something that a management can have control over it by reducing it, which will lead the company also to have a profit margin at the end of the day, a higher profit margin. So these are the two weaknesses that we find for the company.
For opportunities, we already know that the company is very interested in expanding globally. They have already invested in Brazil, in Argentina, in South America, and Europe. But we think that Asia can be another market for them, especially because they are booming economically. There's a lot of growth in Asia. The number of industries increasing, actually population is increasing. So all those can create bigger demand for their product in Asia. So they should definitely look forward. They should definitely invest in Asian market. Secondly, technology, because most of their products are high-end, quality-based products. So advancement in technology can further improve their product quality. They can spend more in that. They can research more in that. Especially the competitors are also good at inventing these products. So that could be an opportunity for the company too. E-commerce, we all know that more and more people are connected globally through internet. So they can reach somebody sitting in China, and they can have more clients by using e-commerce. So that provides them further opportunities. For threats, they are well, it's very competitive. They have the two main competitors, Scoreflex and Euroflex. Actually, one of them was formed by their former employees, and they sell very much similar products to the company that we're talking about. So, I mean, they have to find ways to beat them. They are also prone to financial crisis. It's given in the statement that they saw a decrease in sales, when there was financial crisis in 2008, because their products are high-end. Probably that could be the factor that there was lesser demand for their products. Further, Trump's presidency can bring changes in NAFTA because they export a lot of products to US. So if there are any changes on taxes, that is going to affect them critically.
So now the problem statement. The main problem that the company is facing is that the credit risk. They're very highly dependable when it comes to financing their operating activities, and as well the market rivalry, like my colleagues mentioned. And what steps can the management take in order to solve these issues? And now for the objective statement. What is the objective of the company? The company's main objective is to find new opportunities in order for them to expand and to maintain a stagnant growth.
So by looking at the problem and the objective of the company, we came up with few recommendations. First, because we said that debt is a weakness of the company, so there could be some ways to tackle that issue. They can renegotiate credit facilities, they can renegotiate interest rates, credit terms, payment timings. Because they are a strong company, they have that ability to actually do that. So that can be one of the ways to solve that issue. Further, we know that they have high operating expenses, so they should improve their internal management. They have actually tackled many weaknesses that they were having in the past, but further they can improve their internal management to further decrease discretionary expenses. Then we also looked at, it's given in the statement that the company is looking at different alternatives to grow in future. Some of them were like buying out the competitor or selling their company to a US company. So like looking at all of those, we came up to that they should stick to their product. They should further. They can use market penetration. They can use promotions. They can use marketing. To sell their product further. And secondly, we also we suggest market development, which is going to a new market with the same product. As we said, going to Asian market could be one of them because they want to expand globally. So they should adapt that model than going and buying out a competitor, because that could be a long-term a goal, but they are going to need a lot of resources and a great strategy to do that. But for now, they should stick to these recommendations. And to conclude, we clearly see that the company has a very strong financial position. It has a high profitability, and they are very good at what they are doing. They have potential opportunities for growth. They can grow more, especially in the Asian market. And actually, even their goal is to expand. So yes, and then we also know that they have a lot of competitors around them. So, especially in Canada, there is this company that sells the similar products, so they should definitely watch what they're selling, and they should try to do better than them. And finally, it's high debts. We know that they finance a lot of their assets by borrowing money, so they should, or their operations by borrowing money, so they should definitely reduce that. So that's it. And further, for our investors, we all know that the company is in a strong financial position, so it can be a good time for both aggressive and conservative investors to invest in this company. And so this was our presentation on the company. And thank you so much for your time, and thank you so much for your attention and listening to us. Thank you.
The presentation is now over. The length of the presentation is 19 minutes, 13 seconds. The judges now have a 5-minute period for questions.
We'd just like to have a little, I guess, a little bit more detail when you say in your conclusion that the company is as high debt, but at the same time in a strong financial position. So how do you describe both of them?
Well, when we said high debt, we also mentioned that we don't know what the competitors are doing, like how, I mean, we cannot compare them with them. We just looked at numbers and they seem pretty high, like 56%. That's why we said that. And when we said they are in strong financial position, it's because we see that they are profitable. They have they've been showing a positive net income. So that's why we set both of those needs.
Okay.
So basically from the 5 options here, so you're suggesting option
3. I think it's
3, which is to expanding the foreign markets. Do you think we should go to Asia, where we're not present right now, and maybe try to extend even more our presence in the current foreign markets that we have? We have potential on these ones, or you would like us to go right away to Asia, and not maybe try to increase our market share in these foreign countries where we may have a low percentage of the market share for now, and we still have opportunity to go at first in these areas where we are right now? Or you want us to go right away to Asia?
Actually, if you go back to our recommendations, I said market penetration, which is like we have this product and we have this market where they are already. So they can definitely spend more, they can promote more, they can do more marketing and spend increase sales. And then I said market development, which is the second version of it, because they want to expand. So then there is a chance to go globally.
Okay, so you're saying basically
They
try
can
to
do both.
expand more our presence or have a bigger market share in the current foreign countries or the other countries, but also look at the avenue of go penetrate Asia also at the same time, or in a second step. That's what you mean. Okay, thank you.
Maybe in continuation with this last question, do you think that before going to Asia, there should be some work to be done from the company side to build the market, to have more information to make sure that we are stepping somewhere where we can have some success?
Well, one of the ways could be because they are very strong, they have a strong financial position. They can hire experts, they can hire local people, they can hire Asian, I don't know, people from the respective country, which will provide them data and which will tell them about the demands, specific demands of that country, and then they should go forward with that plan. I mean, it's a long term, but it can be done.
I would just like to hear some thoughts on option number 1, which was to try and buy one of the 2 Canadian competitors. I understand you don't recommend, but why did you say that?
It was basically more because the company didn't have enough cash. In this statement, it showed that really they didn't really have any cash on hand last year in 2015, but they do have cash in 2016. But buying a competitor is also a big challenge for the company. They also need more cash on hand to buy those competitors at the same time, but their debts are also high. So it's kind of conflicting, but it's not something that we do not recommend. The company can obviously go after it, but it's in a long term also, because buying a competitor is not an easy job to do.
I also want to add that the money that they had, they actually spent that money to pay off their debt. So I mean, they already have debt that they should first address to, and they also wanted to redeem some of their shares, which they couldn't because of the lack of cash. So in order to buy a competitor, they should have those resources to go forward.
So according to what you say, it costs the company less money to expand in Asia than to buy local competitors. Because the company will need to invest less money because of cash flow problem or the accessibility to money.
Again, it will come back to the market development strategy that we recommend at the end. It was because they already have the market here and the customers are already existing here. So buying a competitor, it means it's already there. But opening a market for Asian or another country around the world which they are not in yet, it means
The
that
time is now over. I'm sorry. Thank you. Everyone is now invited to read the